So, title, date, Gray disclaimer. As it says in the bottom, I'm a retired partner of Gray & Gray. That is me from a long time ago. You will notice that I have my personal telephone number there, which I respond to unless I'm actively doing something else. There is both my Gray email address and my personal email address. I tend to check them once or twice a day, and I will get back to anything that you do ask me. Before we talk about why now, I want to tell you about my rules. I do have rules and presentations. I believe that the speaker presenter should try and remain as apolitical as possible. If you have a question, ask it at any time. If it is overly political, you can ask an overly political question, and as long as I can do it, answering it without sounding political, I will try and answer it. Don't hold your questions to the end. I find that really doesn't work, even though a lot of questions get answered later on. People tend to forget what they want and everything else. So if you have a question, go ahead and ask it at any time, and I'll try and answer it. So the first question that people ask is, why am I doing this now at the end of July? Year-end tax planning starts, October, November, December. And the reason I'm doing this is not a year-end tax planning seminar. What we're going to talk about, and what I'm going to try and do is to some degree front load this discussion. The math of all of this gets very interesting but complicated. I'm going to do that at the end. And I'm going to try and talk some of the reasons why this is important to talk about now up front. First thing people have to understand is that what we're going to be talking about is not just a math, and it is not just a year-end calculation. There's an awful lot of things that go into this over and above that we should be talking about now. All right. First thing we have to talk about, and you'll understand why a lot more later, is that, in my opinion, people should be taking a long, hard look at their partnership / LLC or S-Corp agreements to see whether or not those agreements actually accomplish maximizing that 20% deduction. Because I think you're going to find that in a lot of cases, they do not. And what we're going to want to make sure that people do is have those agreements set up so that that is indeed maximized, and you get the maximum deduction from your taxable income that you possibly can. Those of you that know me and know that I've been doing presentations for Gray for a long time, well over 30 years, know that I love tax-free money. Anytime somebody can tell me that I can legitimately get tax-free money, it excites me. And what we're talking about right now is indeed making some of your taxable income tax-free, taking some of your business income and making it tax-free. And that is something that should excite people and say, okay, how do we legitimately do that? And I want to emphasize the word legitimately. This is not some strange quirk. This is not some strange things you see on TV or any of the rest of those things. This is right in the code. It is complicated, but it is something that is legitimate, and you should have heard a lot about, and you're still going to continue to hear a lot about. It is incredibly complex. The level of complexity can be shown, and we're going to talk about regulations and court cases and everything else in a few minutes. Long ago, 3 months ago, the IRS said they would have regulations on this issued by the beginning of July. Beginning of July came and went. It was then going to be the middle of July. Middle of July came and went. It was then going to be the end of July. We're now at the end of July, and for various reasons, some of which are pretty obvious, some of which aren't, the regulations still haven't been released, because basically there's an awful lot that's in there that even within the IRS's purview, they can't necessarily agree with what they want to do. And some of the trial balloons that they've sent out to various and sundry people, the people have come back and said, do you really want to do that? So it keeps going back and forth. It will get reissued, hopefully in the next couple of weeks. So we'll see what happens, and when regulations do get issued, we'll write something up quickly that talks about anything that is significantly other than what we've talked about. I don't think there will be, but we'll see. Okay. I listen to a lot of people's presentations. I read a lot of people's things. And I talk to a lot of people up here in the middle of God's country in central New Hampshire, where the wonderful Tina and I live. Be very, very careful. We had several couples over here for dinner Sunday night, and one of them started to tell me about this, and I just shook my head and said, no, that's not right. And they said, well, blah, blah, blah told me. I said, well, I'll talk to blah, 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 which I later did. And they had read something from a bad organization and so on. Be very careful with what we're talking about. Make sure the people you're talking about understand what's going on. Talk to the tax partners at Gray & Gray. Talk to the other partners at Gray & Gray. You have my information. I do get back to people. If you have questions, please, please, please ask them. There's a lot of money here that is potentially tax-free. We want you to take advantage of it. That's why we're here. Ask the questions. Okay. I love, I don't know how many of you are old enough to remember Yogi Berra, but there were what's called yogiisms. And yogiisms are Yogi Berra was probably one of the finest catchers, even though he was a Yankee, that ever lived. But he came up with these just incredible things to say. And anytime I have a chance to use one of them, I do, just because it's so much fun. And one of the ones that I really like is, if you come to a fork in the road, take it. And you sit and say, oh, well, that's stupid. But what it really says is, you come to a fork in the road, you better really take a long, hard look at what each one does, and does it accomplish your goals. And one of the things that you're hearing an awful lot of, and you see an awful lot of things written, is, should you convert your business, your S Corp, your LLC, should you convert it to a C Corp? Because people are saying, wow, the C Corp has a flat 21% tax. That's true. There is no graduation in that tax. You have to remember that individuals have graduated tax rates. And what's going to happen to below that 21%, especially when you remember that if you're a C Corp, money that you take out as salary is going to be taxed as ordinary income. Money you take out as a dividend is going to be double taxed. And should you sell your business, and those of you that have heard me, should you sell your business, it is extraordinarily expensive. I am not going to do an extensive choice of entity discussion here. Choice of entity has become even more complex as to what type of entity you should have, why you should have it, what you should change to, what you shouldn't change to, what changing from one type of entity to another type of entity, what that does as far as current and future taxability. The questions are endless. Once again, if you have questions on this line, do you have a question tab open? There are a few questions already. I thought I had a question tab open. Why can't I see the questions? Questions, wait a minute. Okay. Let me go to the top here. I'm sorry. I cannot hear anything. I'm assuming my thing is working because they say my thing is working. All right, let me go to the top here. Can an investment advisor S Corp claim the 20% deduction if the S Corp's taxable income, shareholders taxable, is less than $350,000? And the answer to that is yes. And we're going to talk about that later on when we talk about phase outs and who has to worry about them and who doesn't. I can hear you. Okay. Okay. I think that was the only actual question there. I don't know how to make this bigger, but that's okay. All right. So choice of entity becomes really important. Do not jump into anything. Talk to the people that understand this. Talk to the tax partners at Gray, Gray & Gray. Give me a call, and we can see what we can do. It is very, very important. Sometimes when you do make your choice of entity, it is a one-way street. You want to be very careful. Okay. As I mentioned earlier, we are in what I call Never Never Land here, and no, we are not Peter Pan and Tinkerbell, but rather we were hoping that we would have regulations to clear up a lot of the questions that we have at this time. I cannot hear anything. Is there something that I need to do? I did test my audio and it works fine on my end. And then it says I can hear you. Okay. So we don't have regulations. We don't have court cases. We won't have court cases for years and years. Some of the regulations that are going to come out will probably not be in anything approximating final form. So that we still have some degree of flexibility here, especially probably with regard to this year. It's going to be very important when those regulations do come out, hopefully shortly, that we could read them and get to you as to what you have. If you have specific questions similar to the one before that dealt with what's going to happen with phase outs for different types of businesses, you ask the questions, ask the people at Gray, Gray & Gray, or get a hold of me. I'm usually around, or at least until the end of October. All right. You may have heard that there's a great deal of discussion about a second tax reform act. There are possibly two tax legislations that could go through this year, maybe. One is a second thing of tax reform, all right? And the second is what we call a Technical Corrections Act. There are clearly some errors, as there are in almost every significant legislation that goes through. And what happens is Congress goes through and makes what's called the Technical Corrections Act, where they just kind of tweak a little here and tweak a little there with what's going on. There are a couple of spots in this area and a lot more spots in other areas that clearly need some tweaking that can only be done legislatively. I know that's in process. I think that we can go through. You know, I think that's going to happen sometime in September, but we'll see. All right. Enough for the simple stuff. Simplistically, very simplistically, the general rule is that you can deduct as a deduction, as an exemption, 20% of a taxpayer's qualified business income. Qualified business income generally does not include certain things, but net income is from gains, loss, deductions of business with respect to a trade or business. Trade or business here has a very, very broad definition. And the first thing I want to make people aware of is in the pass-through entity world, since long, long ago when I was much, much younger, back in 1986, there are two types of people that are owners, stakeholders. in pass-through entities. There are people that are passive, right? And there are people that have passive income, which is subject to all kinds of rules and limitations on passive losses. And then there are people that are active. As far as this is concerned, it's ignored. It doesn't matter whether you're considered passive or active. If you have qualified business income, the 20%, subject to all the limitations we're going to talk about, all of that does indeed apply. All of that can be used. All right. All right. Any trade or business other than specified service trades or business, that we'll talk about all those service trades or business in a little while. You saw somebody ask a question whether something worked as long as it was less than the magic 350. Any trade or business here is key. And in this case, on most of the time when we talk about a trade or business, we're not talking about people that are investors in real estate. However, in this case, we clearly are. And we clearly are because one of the things that is specified in the legislation is that 20% of the aggregate amount of qualified REIT, real estate investment trust, dividends, and publicly traded partnerships qualify for the 20%. That's very, very important, because what that says is that real estate investments, subject to something we'll talk about in a few minutes, are going to apply. Real estate investment trusts, if you invest in a real estate investment trusts, the wonderful Tina and I have investments in several real estate investment trusts. If you have those and you get dividends from them, that means that 20% of those dividends can be excluded. That's a big deal. It clearly indicates, clearly indicates that, with the exception of what we're going to talk about in a few minutes, real estate does apply. Just have to, okay. Okay. However, portfolio income, capital gains and losses, dividends, and interest are generally excluded. We talked about the exception of REIT dividends, which do qualify, and capital gains that are directly related to the trade or business, we think, and that's one of the big hangups in the regulations as to which capital gains and losses should be included and which ones shouldn't, as far as, for example, the sale of a business and so on. Can be excluded and can't be excluded, but basically what we're talking about is the operations of a business that this would apply. All right, I mentioned that real estate applied with one big exception. This is the big exception. Triple net leases do not apply. So basically a triple net lease, very simplistically, and I don't want to teach a real estate course here, but a triple net lease, and I just picked up something in my hand because I was playing with it, but a triple net lease says, okay, I'm going to lease you my building and you're responsible for everything. You do the repairs, you pay the real estate taxes, you pay the maintenance, you do everything, you just write me a check. And that's simplistically a triple net lease. And that means that it is excluded. Now, think about what that means, assuming that you are getting income from this. You just wrote something, and because of the way you wrote the lease, you just now are paying tax on more of the income than is necessary than if you had not written a triple net lease. Can those leases be renegotiated and changed? I am not an attorney. I'm not going to advise you on that. I'm just telling you that because you have a triple net lease, this does not apply. And assuming that you have income from that real estate, that's what you're giving up. Can it be changed? Can it be fixed? This is why we're talking about this, and we're talking about it now. every day that goes by that you don't consider doing something about this means that you're losing out on being able to exclude some income. Okay, this is when the real fun starts. And this is why we have to strongly consider going back to our partnership, LLC, and S Corp agreements, shareholders agreements, partnership agreements, and see if we want to change them. Employee compensation of S Corp shareholders and guaranteed payments for services of a partner are excluded. Right? So basically, simplistically, this is what this says. I am an employee shareholder of an S Corp. I run a bakery, it's an S Corp, and I take a salary out of it. Because of that, I am reducing the amount of income that is subject to the 20% by that amount. We're going to show some examples in a few minutes. The same thing is true of a guaranteed payment for services of a partner. Now, partnership income gets more complicated because a partnership income can be guaranteed payments and non-guaranteed payments. And a guaranteed payment is not necessarily for services. It can also be for things like the amount of capital you put in and everything else. Both of those are excluded, and we'll show some math that does that and how much it can hurt you. And this goes back to saying, what do I want to do? What do I want to do with my agreements? This is why you have to talk about this now, because if you're taking payroll, you really can't put it back. If you're taking a guaranteed payment stream, it's going to show that that's a guaranteed payment stream, and it also says so, or should say so, in your partnership agreement. Let's talk about reasonable compensation for a minute. S Corps, by definition, because it's a corporation, shareholders in any corporation, including S corporations, must take reasonable compensation. Okay, Mike, what is reasonable compensation? And I apologize, I like putting funny cartoons and stuff in here. And Judge Potter really didn't talk about reasonable compensation in this. He talked about pornography. But his answer of, I know it when I see it, that's how I can determine reasonable compensation as well. Reasonable compensation is extraordinarily hard to determine and extraordinarily hard for someone to attack, because you have to sit here and say, what is reasonable compared to other people? What is reasonable compared to the income stream of this entity? And so on and so on and so on. So if you're talking about reasonable compensation, it is something you have to look at. And you have to understand what reasonable compensation, what compensation does and does not do for you. All right. Guaranteed payments, and this gets even more interesting. Guaranteed payments to a partner or an LLC member, theoretically, the IRS is challenging this, but they have their problems as well. Guaranteed payments to a partner or a member of an LLC, there is nothing that says that they must be reasonable. Nothing says that a guaranteed payment to a partner or a member of an LLC/partnership has to be reasonable. Now, I know what some of you people have done. I know it's in a lot of the LLC agreements because I helped make comments on what they should be considered. There is nothing that says this. Now, that is true today. They understand that this is a loophole, but this has been a loophole that has existed with regard to LLCs specifically, at least since we started taking advantage of it. Greg and Gray started taking advantage of it in 1999, long ago. I know the amount that's out there. I know the amount of people that are taking advantage of a similar loophole with regard to what they can do and not do with guaranteed payments. So please understand, once again, this is why these agreements have to be reviewed. All right. Why do people take payroll, why do people take reasonable compensation? People take payroll out of their S Corp because they have to make it reasonable. People are taking LLC and partnership guaranteed payments. And this comes to the question of Social Security. This is not a Social Security course. You know, someday if we want, we can have a lovely discussion for about 3 days regarding when is it appropriate to take Social Security, how is Social Security calculated, and so on and so on. But understand that simplistically, the amount that you're going to get in Social Security when you retire, right? I am 71, and I do indeed get Social Security. The amount of that Social Security is determined based upon a formula, and that formula is based upon the amount of pay, wages, and what's called self-employment income. Guaranteed payments are by definition self-employment income. That's how it's determined, the amount of Social Security you get. Now, are you better off having the maximum amount of Social Security, or are you better off excluding as much as you can now and not getting Social Security? I'm not going to make that judgment for you, but it is something that you have to do, and you have to take your pen and pencil, you have to take your spreadsheet, you have to sit down with your financial advisor and see what works for you and your family. There is never is, never will be one universal answer. It is something you have to consider, and it is something that affects your S Corp, partnership, LLC agreements. You should be talking to people about that to see what is best for you and your family. Okay, let's take an example, because this is when the fun starts and you sit here and say, huh? So let's say, all right, that we have a business has $250,000 of business income. And what's determined change, see what happens if I have a sole proprietorship, a husband and wife LLC taxed as a partnership, and a single shareholder S Corp with reasonable compensation of $100,000. This is their only income, and they file married filing jointly. So, and you look at this little chart and you sit here and say, okay, each of them has $250,000. The shareholder has a salary. Therefore, qualified business income for the S Corp is reduced by the $100,000. And now we look at the bottom line. And the bottom line says the proprietorship gets an exemption amount of $50,000. Okay, $50,000 times 20% is, without taking my shoes off, $10,000 in my pocket. Same thing for the partnership. However, the S Corp, because of the $100,000 they took, only has an exemption amount of $30,000. Once again, $30,000 times 20% is $6,000. Taking that salary just cost the couple $4,000. $4,000 is enough money for me to get excited about. So that means that we should be talking about this. Let's move forward. Wait a minute. Nothing happened here. Right? All that happened is they took money from one pocket and put it in another of $100,000 because you were required to, because S Corps have reasonable compensation. And once again, I like my graphics. It doesn't seem fair, does it? But that's the way the rules are. Let's move forward and make it a little more fun. All right? A business has, same business has $250,000 of income. Once again, I have a sole proprietorship, husband and wife LLC, taxed as a partnership with guaranteed payments to either or both of them of $100,000, and single shareholder with reasonable comp of $100,000, same as last time. Uh-oh. That $100,000 of guaranteed payments just cost how much? $4,000 in cash in the pocket of the couple. Now, that also means that they are putting that $100,000 towards their self-employment income and eventually Social Security. Is it worth it? There is no universal answer. This is why you have to sit down now. This is why this is not a year-end discussion. You have to sit down now, sit down with your tax advisor. It's at Gray, Gray & Gray. Give me a call, figure it out, sit down with your financial advisors. Go give Dan Romano a call. He's really, really good at this. Figure out what's best for you, what works for you, and see which makes sense. Do you want $4,000 cash today, or do you want to have more Social Security later? I know a lot of people's answer to that, but you really have to sit down and figure out what makes sense. This is a relatively simplistic example as compared to what we're going to be talking about in a few minutes. But this is why I wanted to emphasize right at the beginning. This is not year-end tax planning. This is now tax planning. This is change, sit down, figure out what's appropriate, and make your agreements, your partnership agreements, your S-Corp agreement, your shareholder agreements, all of which should be spelling some of this out. Make sure it spells it out the way you want it. All right? There are lots of alternatives out there. There are lots of things that you can do. What makes sense for you? My comment here is very simple. If your thing is ever looked at, you want your partnership agreements, your S-Corp agreements, you want everything there to clearly spell things out the way you want it to be in order to maximize what is best for you and yours. Okay, the question initially was actually pretty brilliant, and that was, okay, what happens with phase-outs? And basically, we now have phase-outs, and what happens is that the 20% kind of, sort of, is phased out, and we're going to talk about what I mean by kind of, sort of. And my little chart here says the phase-outs begin for single people, and I'm not talking about married filing separately. That gets even more complicated. But for single, it starts at $157,500 and phases out over $50,000. For married filing joint, it phases out at $315,000 and phases out over $100,000. Pretty straightforward as to what you can do. One of the things I really like here, and I talk about in some of the other things I do about marriage penalties. In this case, there is no marriage penalty if you do the math and multiply times 2. Marriage truly is the same as your singles. Now, okay, I'm over the threshold. I'm over the phase out. Now what happens, Mike? All right, now those of you that have shoes on may have to take them off, and I apologize. This is the calculation if you're sitting here and you're over the threshold. If you're over the threshold, you get the lesser of 20% of your qualified business income. We've talked about that calculation. We understand that calculation. That calculation is pretty straightforward. It gets a little complicated when you have multiple entities and things like that, but for simplicity's sake, I didn't get into, but basically you're going to get 20% of your qualified business income. Now, you've done that calculation. Now you have another couple calculations to do. And all of you that are out there that own real estate, it is now time to truly pay attention. You get the lesser of 20% of qualified business income or the greater of 50% of wages. All right, all of you that are running a business are sitting here and saying, this is great. I have lots and lots of wages, so I get the lesser of 50% of my wages or 20% of my qualified business income. even though I exceed my threshold, I may be right where I want to be. And I know most of businesses that I've dealt with over the course of a lot of years are still going to get 20% or come pretty close to it based upon the greater of 50% of the wages. Now comes the really interesting one. The second greater of, and assume that you're in real estate and don't have a lot of wages, is 25% of wages and 2.5% of the unadjusted, and you'll notice that I kind of highlighted the word unadjusted because this is a really important concept that may need a little clarification. I know what I think it means, and I know what most everybody else thinks it means, tend to agree with me. The unadjusted basis immediately after acquisition of qualified property. All right, so let's talk about real estate for a second. All right, and let's assume that it's not a triple net lease. All right, so let's forget about the wages for a second. Let's assume that you have a piece of property that has an unadjusted basis immediately after acquisition, which as far as I'm concerned means purchase price of $10 million. All right, everybody have that calculator out? What's 2.5% of $10 million? I'll give you a hint. It's $250,000. So think about what I just said. Forget wages for a second. I have a building, not triple net lease, with a basis of $10 million. I am going to get the lesser of my business income from my rent, or $250,000. Okay. Now, I'm not going to get into real super detailed calculations here because all it does is put people to sleep. But this is really important. Anyone that is out there as a real estate investor has to understand this. They have to understand the amount of money that we're talking about. 20% of $250,000, assume that's the number for a second, is $50,000 that's not taxed. That is something worth talking about. That is something that you should be looking at your leases with. Again, it's the lesser of the QBI or that. All of this you have to be looking at. All of this has to be planned. All of this has to be spelled out in your partnership agreements, in your leases, and everything else that's out there. Right? Because you should be doing it. You should not be doing this in October, November, December. You should not be doing this next January, February. You should be doing this now. All right. All right. Somebody asked a question before, and who is limited. Now comes another thing that gets to be really interesting and kind of funky, if you'll excuse my language. If you go over the threshold, those personal service entities, which include health, law, consulting, athletics, financial services, brokerage services, or any trade or business, and I put this in red, based upon personal reputation. All right, so I guess we understand what health, law, athletics, financial services, and brokerage services are. Do we really understand who is a consultant? So, am I a consultant? I really, well, maybe I do talk about financial services, but who's a consultant? When I brought somebody in here a couple of days ago to look over some electrical questions we have here in our house because I wanted to see if we could do some things. And he gave us some things. Now, was he consulting about our electrical stuff? All right. Or was he a contractor? I don't know the answer to that question, and that's going to be one that we're going to need some guidance on or whatever. And the second one is even better, and that is any service based on personal reputation. Okay. I don't want to get into all the politics of it, but some of you may remember that there was a court case, I guess it was out in Colorado, Supreme Court case out in Colorado, as to whether or not this bakery could refuse to bake a cake for a gay couple's wedding. I don't care about the politics is irrelevant. That couple went to that bakery based upon their reputation, all right? Does that mean that because it's based on their reputation that this doesn't apply? We have very good friends here in the mountains of New Hampshire, and he is a contractor, general contractor, fairly, of fairly simplistic, things. He'll do some basic kitchen work or whatever. And they were over for dinner the other day, and everything else. And the question comes, well, do people hire him based upon his personal reputation of what he can do in doing over their bathroom? And does that mean that if he makes over this, he's excluded? So we really don't know what based on personal reputation means. And I know that is one of the things that the IRS is really wrestling over as to what does that mean. All right. God, somebody asked me a question. If you change your lease from a triple net lease during the year, do you have to prorate deduction, or does it matter when the lease says the end of the answer is, I don't know the answer to the end. All right, the question someone's asking is, they have a piece of, and I'll come back to this in a minute. They have a piece of property that they are doing they're doing a triple net lease for, and they go and say, okay, person I'm leasing it to, from now on, I'm going to pay the real estate taxes, not you, and I'm going to raise your lease by whatever to accommodate them. And if I do that today, at the end of July, do I then have to prorate the income that I can use this for, and it's only available for 5/12 instead of an entire year? My answer to that is yes. I'm not going to tell you how to write things, how not to write things, what your attorney will do, what your people that you're leasing to will do. I'm not going to get into that. But assuming that you go in and change the lease effective today, that would be my answer. Again, this is why I'm saying this is not year-end stuff. This is now stuff. These are things that you should be doing. Hang on. If income from personal service income is below 350, can the partner take 20%? Assuming we don't fall, yeah, the answer to that is yes. Assuming that they are 500. For example, a company which takes management fees. Oh, I know who this is from. Yes, so that basically I am a management company, all right? And I would say a management company is probably we'll talk about that another day, but I would say that they're under the $315,000. They get management fees, let's assuming it qualifies as the personal service entity. Doesn't matter. Under the 315, 20% applies. You get over it, and all that. If you're in this area, in the personal services entity, your SOL, anybody else has to go in that incredibly complicated situation. Once again, these things, and when I'm giving you a nickel tour here. It's a lot of things that you have to do, a lot of things you have to discuss. Pick up the phone, call the guys at Gray, pick up the phone. I'm around most of the time, most days, till the end of October, when wonderful Tina and I start our travel season, and then we're off and on. But these are things that you clearly should be looking at now if you want to maximize this. Qualified property, when we talk about property, and it could be a machine, it could be whatever else. Is anything held and available for use in the trade or business? Once again, trade or business has a broad definition here. A building is in the trade or business, assuming it's not triple net lease, which is used at any point during the year. It's placed in other words, it's placed in service, and it is not fully depreciated before the end of the taxable year. That's going to need some clarification, but basically, if it's in my definition, if it's fully depreciated during the year, it's not going to qualify for the amount. But again, these are things that you have to look at. These are things you have to talk about. When do you buy things? When don't you buy things? The whole question of the calculation gets into play. Okay. Tom owns commercial real estate and has a management company to run it. No payroll. He has income of $1.5 million. The unadjusted basis of the property is $2 million. I know the numbers don't make sense, but live with me. The deduction is the lesser of $300,000, 20% of $1 million, or $5,000, 2.5% of $2 million. That's the simplistic, very, very simplistic answer. So basically, in this case, Tom is going to be limited to the $5,000. Now, what about the question of management company? Is a management company a personal services company? Is it a consulting company? Now, I will tell you that it is my understanding, based upon some people, some friends that I have that are real estate brokers, they are real estate agents, and they have been told several months ago that their national association believes that they are consultants. I'm not sure I agree with that, but it doesn't matter. They have said it, and that kind of does things here. In this case, I would make sure that all of that income, as much as possible, is going with the real estate, not the real estate company. But in this case, I would say it wouldn't be anyway. But this is where all of the discussion is going to come in, and this is the other reason why you got to start talking about this tomorrow, this afternoon. You got to start looking at your agreements and make sure your agreements are written in such a way that it is maximizing that which you're going to get. Okay. Lucy owns a printing company. She has income of $500,000 and payroll of $160,000. She devised a new machine for $100,000 and placed in service with all her equipment. Okay, first question. And I like this because I actually got this in a fortune cookie and kind of cut and paste to put this in. Your reputation is your wealth. Is a business based upon personal service? Can a printing company, in this case Lucy, can her business be based upon her personal reputation? Aren't a lot of businesses, operating businesses, based upon someone's personal reputation? All right. Here in the mountains where we live, there's a beautiful little shop where my wife goes periodically to buy clothes. And she goes there because she knows that people that are there, she has great faith in the people that are there. She has great faith in the products that they sell. Does that mean that that store is based on a personal reputation? My answer is no. It's a retail store. I don't know what somebody else is going to say. The question of personal reputation is really, really important. All right, so let's talk about this example. All right, I have $100,000. I have $250,000. I have $80,000. So basically, where am I going to be? I have 50% of payroll, which is $80,000. I have $100,000, which is 20% of the $500,000. And I have 25% of the payroll and 2.5% of the machinery, which is $42,000. So now comes the interesting thing. I have the greater of the $80,000, because doesn't this get to be fun? Of the $80,000 of the $42,000, and the lesser of the $100,000 and the $80,000. So basically, it's $80,000 that this is. Well, again, this gets back to the question of how much payroll do you take? How much do you take? What is all the things that are going to go in? What is the math when you take things away from payroll and put it into your qualified business income? All of this gets to be just more and more complicated. You got to sit down, you got to talk to people and plan this thing out. A business has $600,000 of business income. Oh, they're mowing my lawn. All right. Has $600,000 worth of business income. Sole proprietor, husband and wife, an LLC taxes a partnership, and a husband and wife shareholders of an S Corp, which has reasonable compensation of $60,000 in the S Corp and a similar guaranteed payment in the LLC. Other payroll, $50,000, equipment of $100,000, all married filing separately. Okay. Now this one comes to an interesting decision, okay? And you know, the math here, I'm not going to do all of the math here. I'm going to make you do it. But in this case, what is interesting here is that because we take the payroll, which is now $110,000, and if I take 50% of $110,000, it's $55,000, and I compare that to everything else, in this case, taking more payroll actually winds up with the best answer, right? Because I'll exceed the threshold. So if I take 20% of the business income, which is $120,000, I then have the lesser of that, and in which case, in this case, it winds up with $55,000 compared to $25,000 in the other two cases. Again, and I know I'm putting everybody to sleep, but all I am saying, and I'm saying it over and over and over again, is every pass-through entity has to sit down and has to talk about things. I want to talk about one other thing, and you know, there's my little, you know, aggravation at all this calculation. I want to talk about one other thing before I go to married filing separately. Many partnerships have two classes of partners. They have equity partners, those partners whose income is solely based on the operations of the company, and non-equity partners. And non-equity partners usually just receive a guaranteed payment and don't receive any other share of the partnership income. Because those are guaranteed payments, they're a deduction. Right? Now, can the partnership agreement be rewritten in order to change that? I don't know. Wait a minute. Somebody thinks I did the math wrong. For example, what it takes a management fees, it's $50,000. Oh, I may have screwed up the math. Yeah, it's $50,000. Did I say 5,000? I'm sorry. It's 50,000. But you have to sit down and say, okay, what do I want to do with these people? How do I want to do it? Does it make sense to have these people, and how are we doing it? Again, this is partnership stuff. This is partnership agreement stuff. You should be sitting there and saying, what do I want to do? What do I want to do with it? How do I do it? It just gets more and more and more complicated, and I put more and more people to sleep. There are situations when, amazingly enough, and you know, if you read all of the documentation, there are situations where you're actually better off doing married filing separately and getting a benefit that way. Again, you got to push the numbers and see what the math says. It is unusual, but it does happen. There's one other thing which is kind of interesting in this case. There is a change in the accuracy penalty for understatement from this, but then again, if you're using competent people, that's not going to happen. I just want to make sure that I include that as I run out of my 1 hour time. So basically, I'm at my 1 hour, and I tried to cram everything in. Once again, that's all of my information, along with all my, at least most of my initials after my name. That is my cell phone number up here in the mountains. My Greg Rangray email address, my personal email address. I'm almost always around and will respond. I do check my email, both emails, a couple times a day, so that you can reach me. Please, 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 there's an awful lot here. I'm spending the time now to make sure people at least understand that you've got to go out and you have to plan this stuff. And don't do it at year end. Year end is not the time to do this. You'll have already made all kinds of payments. Now is the time to sit down, look at your agreements, make sure your agreements actually accomplish that's what you want. What do you want to do with regard to Social Security? What do you want to do about this exemption of income that puts cash in your pocket now, as opposed to possibly Social Security later? All kinds of ramifications that you have to think about, that you have to talk about. If you have any questions, I know it's pretty hard to write these things down. I'll be home for another hour or so. Then I'm probably going off to the gym for a couple hours, and then I should be back home around 2 o'clock, and I will look at things again. So if you have questions, feel free to give me a call. I'll be here for an hour. Email me or whatever, and we can do whatever. I want to thank everybody for attending. I want to say I hope you had a good time, and you learned something, or at least learned enough so that you now can go out and ask lots of questions to people. Thank you very much.